Hey, good afternoon and welcome. My name is Matt Price of the Price Group. Looks like we still have a number of names filtering in here, so we'll give it one more minute. But this afternoon, we'll be discussing retirement planning timeline. So a lot to cover. I see a few new names, a few familiar names as well. We appreciate those of you who are coming for the first time, as well as those who've been to a few of our webinars. It's always good to see a familiar face. So with that, let's go ahead and jump in. Randy Price, he tried to tell you he's my older brother. He's actually my father. Myself, Matty Kearns, make up the advisors for the Price Group. Family owned and operated. We follow a fiduciary standard. We think that's very important. And we have a niche in retirement. So 80+% of our clients are actually retired. The other 20% or so are on their way, typically pretty close to retirement within 5 years or so. So we've really made that our area of focus over the last decade, and we will talk about it, but we think there are quite a few salient differences when you compare saving for retirement to investing while retired. We think a specialist is a bona fide need in this area. Few accolades that Randy and I have received. Randy from Barron's, Forbes, Financial Times. I've gotten a few from Forbes, a few other publications as well. All three of us, Randy, Matty, myself, certified financial planners. Randy and I went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. We think education is really important, something that we take very seriously. Our firm, Steward Partners, is built off the biblical definition of stewardship. We have 40+ offices around the country. They've been a good partner. And then our custodian, Raymond James, that's where client assets are held. Very fiscally conservative run operation. They took no TARP bailout money in 2008, which we think is a real key to knowing if someone really did run their organization in a conservative manner. And they also are listed in the S&P 500. So they've been a great vendor, a great partner of ours as well. So what we're going to look at today, planning 2 to 5 years out, less than 1 year out, and then actually some planning after retirement, which sometimes catches people by surprise. So jumping in 2 to 5 years out, we think one of the most important things is actually look before you leave. We think creating a wealth plan, an investment game plan for retirement is paramount. We call ours a live well plan. We call it that because we want our clients to live well, and we're a little bit of cheese balls and couldn't come up with a better name. But in that plan, we develop what we call our family index number, where we're developing a rate of return that is peculiar to your family to see what rate of return you actually need in retirement to be successful. And unless you tell us otherwise, we're going to solve for the least amount of risk necessary to do just that, to have you have a successful retirement. But we also are looking at plan contributions. And then we're really studying what's the consequence of a negative year in the stock market. We talk to people all the time who say, well, I'm really conservative. And we look at their portfolio and they're 100% invested in stocks. And that's great. You know, we wrote a blog today talking about when stocks go up, you never have enough. When they go down, you always have too many. But once you get a few years out from retirement, that's really when you want to start thinking about what's your risk budget in retirement, or said another way, what type of stock versus bond ratios, and include private investments in there now for families where that makes sense, do you want to have in retirement? Our advice is going to be, let's get you close to where you want to be 1, 2, 3, 4, 5 years out from retirement. Just so Murphy's Law is that you retire on a Thursday, but the market has a 10% pullback the week before you retire. That's what we don't want to see happen, and something that's very avoidable with some simple planning. And then hiring a qualified advisor, we think 5 years out is really the time that you should be shopping for someone who specializes in retirement. A lot of people that we talk to have never had an advisor. They've just done it themselves. We also talk to a lot of people who have had advisors, but their advisors are more, I'd say, generalist, who don't necessarily focus on retirement. So 2 to 5 years out, what we're looking at here, this is a look at trying to figure out, is your spreadsheet adequate for retirement? And the short answer would be no. Spreadsheets are very good for your working career, but in retirement, they come short just based on the sequence of returns. So 4 boxes here. Let's look at the 2 boxes on the left. Those 2 boxes represent your accumulation phase, or while you're still working, adding money to your savings plan, to your 401k, wherever it might be that you're saving. The top right box, most specifically, you start with a negative 15% rate of return in year 1. Years 2 through 9, you get that 7% rate of return. And then in the 10th year, you have a good 29% rate of return. You start with 100,000. You see in this example, you end with $188,399. Now, let's take the same returns and put them in reverse order, the bottom left-hand box. You get that good return in year 1, the same returns in years 2 through 9, and then a poor return in the last year of negative 15%. So same returns as our first example, but just in the flip opposite order. And what you see here, while in the accumulation phase, or while you're still working, this number is exactly the same, $188,399. So what does that mean? That means that the order of which you get your returns while you're still working, it does not matter. However, there's a stark contrast when compared to retirement. So let's transition to the 2 boxes on the right. Once again, starting with $100,000, but the only thing is we're taking $10,000 out a year. With a negative return in that first year, you run out of money somewhere between years 9 and 10. It's not good. But the bottom right-hand box, you get that good return in the first year of retirement. And at the end of the 10th year, you have still over half of your money left. So the point we're trying to make is the order of which you get your returns in retirement is very important. And that's something that we want to talk about 2 to 5 years out from retirement, so you have proper time to plan for how much you need to save. Maybe you can throttle back your saving. We actually see that a lot. Or maybe you're saving exactly the right amount. So with that being said, orders really matter. We use what we call Monte Carlo simulation. We actually will show clients retiring 1,000 times to take that order that we don't know of which the returns will happen into account. We think 2 to 5 years out, you should go from really thinking about only investments to thinking about it from a more holistic perspective. And holistic, we can include the following: retirement, investments, insurance, cash flow, estate planning, tax planning. All of these really come together to create that cohesive plan that I mentioned. We refer to ours as the Live Well plan. But Benjamin Graham, we think, said it best: the best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and behavioral discipline that are likely to get you to where you want to go. We think that's very true, and we would argue more true in retirement than probably your working years, of having a plan in place and needing to have that behavioral discipline in place for future choppy markets. So what should a retirement plan include? We don't think retirement is an event. It's not something where you just check the box and you're done with it. It's an ongoing process. We think the plan needs to be written down. But part of this Live Well plan, we're answering the questions: how much can we spend? How long will our money last? What rate of return do you need? I mentioned that family index number earlier. And then how do you invest? A lot of people come to us and they've been very growth focused, which is good. But prior to retirement, a few years prior to retirement, we think it's time to really consider shifting the way you think about investing. And we're big believers that everything that you should do from an investing standpoint in retirement should be predicated around producing income. That means dividend-paying stocks. That means private credit strategies, if they make sense. That means bonds, fixed income, CDs, whatever the vehicle might be. Our goal is to produce income to meet your income needs, because in a perfect world, we'd like you to see you selling no principal and only living off that income from the dividends and the interest. So I mentioned it earlier, that family index number. We're trying to get there, and there is typically into your early or mid-90s with the least amount of risk possible. Now, some families will come back to us and say, hey, I get that you're trying to take a lower amount of risk. My goal is to grow this for the next generation. And 2 thumbs up, we can help accommodate those goals as well. But we typically will lead with showing the least amount of risk just so you have a baseline of what is needed moving forward. And then we can massage it from there. Some families want to take more risk, some will actually want to take less risk, but it's not a set in stone. It's just we want to kind of show you what we think makes sense just purely from a quantitative way of looking at it. So something we like to do in these presentations is, while we're giving you a lot of information, we want to give you a few concrete examples of maybe something you can do prior to. The numbers on here are a little, no, we've updated them. I love that. Okay, so I was going to say they're a little old from last year, but the numbers actually have been updated. This is an alternative Roth IRA contribution. Said another way, this is a backdoor Roth contribution. This makes sense if you are over the threshold, you can't add money directly to a Roth IRA. What you can do is you can add money to a traditional IRA and make that non-deductible. So that's not going to have any deduction on your income tax return. Say you're 52, you can put in $8,000 this year. The next day, you can do a Roth conversion for that $8,000. Now, you don't pay any taxes on that $8,000. You would only pay tax on if there's any gain. In this example, we're doing it the next day, so there would be no gain. This is a great strategy, but the place we see a lot of people who are not using our services stub their toe is they don't take the pro rata rule into account. And what that pro rata rule is if you have any other pre-existing IRAs, you have to also think about them when you're doing this type of conversion. So you can't have $1 million IRA sitting here on the side, and then you just do this strategy with $8,000 and not take this $1 million IRA into account. So it makes most sense if you have no other pre-tax IRA dollars. We've talked to a number of CPAs. The general feedback that we get from the CPAs is that the 401ks can still be had and do this without the pro rata rule taken into effect. So we're not CPAs, we don't give tax advice. Talk to your tax planner, but that's what we've been told by a number of CPAs as it pertains to doing that. So once again, this strategy should be possible if you only have pre-tax 401k dollars, not IRA dollars. And then a second idea, think of it maybe as the kissing cousin to the one we just talked about. But this is a Roth 401k contribution. This one's going to be a little bit more peculiar to your plan with your employer. So some employer 401ks now have what they call an after-tax option. So you got your pre-tax option, you got your Roth option. Some of them have this after-tax option. Not all plans do. So check with your provider to see if you have this option. But you can put money into an after-tax bucket. Say you put in $10,000 on top of your pre-tax or your Roth contribution. You put $10,000 in this example into the after-tax bucket. It grows to $20,000 by the time you retire. Well, you can take your contribution to that after-tax bucket, or in our example, $10,000, and roll that into a Roth. And then you can take the appreciation, which is also in our example, $10,000, roll that into a pre-tax IRA and pay no income taxes on that. So think of it like a supercharged way to add money to a Roth account. Food for thought, just as you all still have access to the employer work plan 401ks. I mentioned it briefly earlier, evaluating our risk budget. What we're looking at here in this chart, we're looking at a 15-year period from 2000 to 2015. The purple line represents the S&P 500 or the overall stock market. And then the green line represents what would have happened if you took 50% less risk than the overall market. And you can see you come out ahead there, taking less risk in a very choppy period like this. So we think that is something to at least consider when you're getting closer to retirement, is we see a lot of families needing to reduce that risk budget just because those few years into retirement, we want that ride to be more like the ride in retirement to prevent poor timing of when you actually do retire. And then hiring an advisor. You can look here at the 30-year annualized returns. We don't have the 2024 numbers yet, but year over year, they're really similar. You can see that the average equity investor underperforms U.S. equities, and then you can see that the average fixed income investor underperforms bonds and actually, unfortunately, inflation as well. We think now is really the time to consider the fact that mistakes are a lot more costly the closer you get to retirement. I like to say if you're 28 and you make a mistake in investing in the wrong thing, you kind of go, well, lesson learned, and you move forward. But if you're planning to retire on your 61st birthday, just in a few months, and you make a mistake, it could be a really costly mistake. So that's what we want to avoid in those few years leading up to retirement. Now let's transition to retirement planning less than 1 year out. What should that look like? We need to really hone in and estimate those retirement income needs. A lot of people have a good feel for what they spend while they're working. What we have found is a lot of times that number is going to stay pretty stagnant, but the way you spend money is really going to change. So more travel, more gifts to grandkids, less, gas driving to work, less new clothes, go down the list. So we see it a lot of times to balance itself out, but we want to study that and make sure that our numbers are good. This would be one of the real ways you could shoot yourself in the foot, is thinking that you might spend $10,000 a month, but you get 6 months into retirement and you say, well, I actually think I need $12,000 to $13,000 a month. That's going to have a material impact on your Live Well plan if we're projecting you being retired for 30 plus years. The pension versus the lump sum, arguably one of the biggest financial decisions you'll make in your entire life. We have a full bona fide process to help you walk through this, to show you the pros and cons on each side. We're not going to make the decision for you, but we can really help you. We can really arm you with a lot of information so you can make what you think is the best decision for your family. If you retire before 59 and a half, we need to be a little more cognizant of how you're going to get access to monies. Obviously, anything you take out of the IRA prior to 59 and a half would have a 10% penalty associated with it. But we have some workaround, some flexibility on how we can access some money without getting that penalty. That's its own kind of unique set of planning that we do family by family. Creating that retirement income strategy. Like I said, we think everything in retirement should be predicated on producing that income. The discount rate. I had one client tell me, he said, the discount rate, I could care less for 30 plus years. And then I got 1 year out from retirement, and it was the most important number in my entire life. So we see that actually being true for a lot of families. Is a lot of families have paid little or no attention to the discount rate, but the quarter of which you retire can have a real drastic effect on that pension lump sum value quarter over quarter, year over year, just based on what interest rates are doing. So evaluating ordinary income and capital gains rates. And then if you haven't hired an advisor, we think 1 year out, still time to do that. So the income needs in retirement. Randy likes to say the bank of mom and dad is always open. We think that's true. We like to build in gifts, helping family, kids out, whoever it might be, in some financial endeavors. Inflation in retirement really is the hidden tax. We've thankfully seen inflation move lower here over the past 12 months or so, not down to that 2% target that the Federal Reserve would like to see, but we are close, sub 3%, with the most recent number published last week. Big ticket items, we like to plan for those, a new HVAC system, a new roof, new cars, go down the list. The point is we want to get really detailed in this Live Well plan. So this Live Well plan is not some cookie cutter type of 4-page document where we just show the same to everyone. Our goal is to be really tailored to each family and make it fit more like a custom suit opposed to something that you just buy off the shelf, because we think that retirement is that important. We think every family does need that custom suit type of experience to have a successful retirement. But on top of that, what are fixed versus variable expenses? Typically, we don't see families spending as much on travel in their late 80s as they did in their 60s. So we like to modify and adjust those numbers as we deem appropriate. and then gifts to family and charity. A lot of families will tell us we don't want the check to the undertaker to bounce. We have some families tell us we have a goal of leaving, pick a number, $1, $2, $3 million per child, and we're solving to try to have them have that amount of money left at the end of the plan. How much to take out from an investment portfolio? It's a very good question. It can be a loaded question. And what I mean by that is it depends on a number of factors. How old you are, what type of portfolio you have. But we've gotten the question a few times, well, Matt, Randy, instead of taking 4% out, can I take 5% out? It's only 1% more. And that is a good train of thought, good logic, but the difference between 4 and 5 is actually a 25% increase. So while it's only a 1% increase, it's on a percentage basis, it's a really big increase. There was a white paper that was published a few years ago, and the title we thought was quite catchy, is 3% the new 4%? You know, that 4% rule has been around since the 70s, where you can take 4% out of your portfolio and everything's going to be fine in retirement. But with interest rates still being a little subdued compared to long-term averages, the article was suggesting maybe we can't take as much out from the fixed income piece as we have in the past. So is 3% that new 4%? Maybe. Depends how old you retire. It depends on your spending needs. It depends on a number of factors, but it is at least something to consider as you do approach retirement. So company pension versus the lump sum, a lot of pros and cons to each. I want to look more specifically at the questions to consider. What we're always going to do, assuming that you're married, that is, we're going to compare that 100% joint survivor number on the pension to the actual lump sum. And in there, let's just kind of make an example up. Say you were getting $6,000 a year from that pension, okay? And say the lump sum was $100,000. You would take that 6,000 divided by 100,000, comes out to a 6% number. Some people will tell us, well, you can't do better than 6%, Matt and Randy. This is a guaranteed 6% rate of return. And that's not really telling the whole story. Part of that 6% is going to be income, returns, quote unquote. However, another part of that is going to be return of capital, i.e. you selling down your investments year over year. So we'll joke and say, tell us how long you'll live and we'll tell you exactly which one to take. But that's part of our process I mentioned earlier. We'll go in there and we'll really kind of show you the numbers on that breakdown to see what your imputed rate of return or your hurdle rate would be to be better off, quote unquote, taking the pension. The biggest thing from our perspective, though, is what do you think inflation is going to do? And locking into the pension, the company pension, typically you need to have the idea that inflation is not going to be an issue moving forward. If you think there could potentially be inflation in the next 1, 2, 3 decades, the lump sum is going to be more in a more effective way to fight that inflation moving forward. So that pre-59.5, what are a few of the strategies you can do? Well, you can make a one-time distribution while rolling over into an IRA. The 72T is something that makes sense if you're younger than 55. Sometimes we can set a systematic monthly or annual distribution for the greater of 5 years or until you reach 59.5. And you just have to take that same distribution for that period of time. Net unrealized appreciation, we have a whole other presentation just on this, but that's a way to get the company stock outside the 401k in a more tax efficient manner. Lines of credit, we've seen those make sense. And then a lot of clients end up doing some type of consulting or part-time work where they go back and start doing something they love to really keep their mind sharp, but it also helps in the Live Well plan. And then obviously after-tax assets, those play a critical role until you get to that magical 59.5 years old. Mentioned earlier, we think retirement is all about income. Here's a look back at the dividend contribution by decade. And the royal blue there is what percentage of the total return has come from dividends. If you took the average of all these, it's going to be really close to a 40% of the overall return. So almost half of the total return from the stock market over a long period of time has come from dividends. Bottom line, we think dividends are really important, and we're of the opinion that moving forward, we don't think that the markets go up nearly as quickly as they have for the last 10 years. I hope I'm wrong. I hope we see markets just move straight up, but we don't think that's the case. And if that's true, we could be entering a period where dividends actually make up a higher percentage than that long-term historic 40% number, like you've seen in some decades when stocks did poorly, like the 40s here, or the 60s, the 70s, where the dividends made up a much larger percentage of that total return. So we think dividend income is your friend leading up to and also being in retirement. Then here's a look at how we think about bonds. And we say the word safe there in italics. Are bonds actually safe? And it all depends. What we've done here is we've taken a few decades and we've broken them out on a real basis. What we mean by real basis is we factored inflation into that number. So 1928 through 1940, you got a 5.6% rate of return on your T bonds. After inflation, 2 thumbs up. Everyone would probably agree to sign up to that for the bond or the fixed income part of their portfolio. However, 1940s to 1960s, on an inflation adjusted basis, you were backing up almost 2% a year from the T bonds. So most clients would say, I'm not interested in locking in money if I'm going to lose 2% a year. So we think moving forward, the ability to be flexible and nimble with your fixed income is increasingly important, just based on where interest rates are and the fact that bonds on an inflation adjusted basis are not always good investments. So we're not anti-bonds. A lot of clients own quite a few bonds, but we think the type of bond you own really matters. We think it matters a whole lot more than maybe your parents' retirement from 20, 30, 40 years ago, where there just were a lot less bond options to pick from. Here's a look at investing without a process. And the grayish line here is the overall stock market. The bluish line are when money is flowing into US mutual funds and ETFs, or when it's down here flowing out of. And what you can see at the end of 2002, the market was down, as you may remember, 2000, 2001, 2002. At the end of 2002, you saw one of the biggest sales of US mutual funds and ETFs when the market was at its low. Same thing happened end of 2008, early 2009, market hit its bottom, and what happens? People are selling stocks. And this isn't just our opinion, these are bona fide facts. People tend to sell at the wrong time. They say the pain is just too much, we need to get out to preserve what we have. And typically when people do that, they're selling at the bottom. So having a process is very, 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 did I say very important in retirement to prevent yourself from selling at the quote wrong time. And that's really what our investment process is designed to do. So also answering how much can you spend in retirement? How do you invest to meet your needs on a monthly basis? We think discipline and income generation should be at the center of any retirement investment process. Our goal at the Price Group, we want to preserve your assets while generating the level of income you need to meet your objectives with confidence. So let's transition to planning after retirement. We think there's quite a bit of planning to do that post-retirement date as well. We'll continue to stress test your portfolio. So a look here, intuition might tell you if you were down 20% in your portfolio, you only need 20% to get back to break even. We're here to tell you that's actually not true. If you were taking out 4% from your portfolio, you had a 3% inflation rate, and your portfolio is down 20%, you actually need a 36% rate of return just to get back to where you were. And so our point here is this: managing risk is really important in retirement. It's something we take very seriously. In a lot of our client review meetings we've had over the past year, we look back to 2022. 2022 as a way of reminder, the stock market was down almost 20%. The bond market was down approximately 14%. And we show the client, we say, hey, you were slightly lower. Happy to report a lot of clients were down less than the overall stock market, than the overall bond market. And it's the only negative number year by year and kind of what we're looking at. And I kind of say to them, I say, this is actually your best number. If they were down, say, 2%, 5%, 10%, whatever the number was, and they kind of look at me and say, I'm not sure I understand. This is the worst number on the page. But what we were able to do in 2022 was reduce some of that downside risk from the bond market through the stock market. So it's not a promise or a guarantee that we'll do that moving forward, but that's what we've seen historically. And that's why we think managing risk is so important in retirement. A few other ideas for consideration: QCDs, qualified charitable distributions. Once you reach age 70 and a half, you can actually give money from your IRA to a charity, and then it can offset that RMD once they start at age 73. Gifting of appreciated stock is another idea. We see a lot. Say you want to give $10,000 to your church, gifting an appreciated stock that is a very low cost basis, gift it to the church. The church pays no capital gains, and you still want to own the stock, so you spend $10,000 cash just to buy the stock back. It's a good way to reset your cost basis. Talking about Roth conversions when applicable, we think it's a high honor in this country to pay tax at 10 or 12%. So maybe there's a period between when you retire and reaching 73 when your RMDs could be really high. We want to do some Roth conversion planning in the years in between to see if it makes sense to use up some of those lower tax brackets. And then we think planning in retirement should be benchmarked against your goals. So I mentioned that family index number. That's something we're looking at for clients. We're comparing their progress against their Live Well plan using that family index number to know if they are ahead of track, behind track, or just right on track. So happy to create a Live Well plan. If you've already had one created by us, happy to review it as well. Randy sometimes thinks he's an old Baptist pastor talking about the 3 C's: comfort, confidence, and clarity. But that's our goal. That's what we want to deliver when doing this. We do this on a complimentary basis for you to kick the tires. And then for clients, we update this on a regular and reoccurring basis. So with that being said, those are our prepared remarks, and we are just right on time, actually, 30 to 35 minutes in. But once again, I'm Matt Price, Randy Price, Maddie Kearns, along with Preston, Tiffany, and Melissa, and certainly do appreciate you making some time for us. If you have any specific questions about your own situation, please feel free to reach out by way of phone or email, and we would love to continue the conversation. Thank you much.